Well, howdy, and welcome to Texas A&M Law's graduate program for wealth and risk managements. I'm calling it State of the Economy for first quarter, and I hope that we are able to do this each quarter with our distinguished guests. I'll introduce in just a moment with their bios, but James Nevels, who is both a graduate of our program and a faculty member now, thanking him very kindly for that and lending his very distinguished name to us. And George Mentz, who has literally been with this program since it moved to the United States in 1998, literally since 1998. So we moved 25 years later, and we've been online that entire time. So with that, I think that people have had an opportunity to join in. I'm going to go ahead and read off y'all's bios, and then we'll get into today's main topic area about inflation, interest rates, and what investment managers, including, so we teach both wealth and risk, should be looking at for 2022 and into 2023 for whether it's balancing portfolios or for personal investments like William Burns, who has a retirement account. Okay, so James Nevels, his background, he's our distinguished speaker today, is chairman of the Swarthmore Group, Philadelphia-based investment advisory, which he founded in 1991. He has 40 years experience in the securities and investment industry. He's the former chair of the Philadelphia Federal Reserve Bank and is serving or has served on the board of several U.S. public companies, Fortune 500. Household names like Hershey, Alcoa, maybe not as household for the public, for consumers, but WestRock, which is the #1 paper and packaging company in the United States, I think globally. He is current chair of the board of the Business Council of International Understanding, which is the environmental, social, and governance organization, everyone refers to that as ESG now, of the largest U.S. multinationals. George Mentz is a well-known investment author and has a weekly column with Newsmax. We're including some of the links to his past 3 articles, really enlightening. They happen to be particularly on our topics of inflation, interest rates, and where we should look at for investments in balancing our portfolios. He's the CEO of the professional certification body of the Global Academy of Financial Management, and he founded the Association of Certified Chartered Economists. George Mentz owns various newspapers and media outlets, and he's a member of the recommendation board for the U.S. Presidential Scholars Program. I'm William Burns. I'm the original founder of the Wealth and our Risk Management Program back in 1994. And I have to tell everyone the news who's listening, the rankings just came out for law schools, and A&M is now first tier. Congratulations to us, as we say at Aggieland, whoop, and then we also say onward and or keep moving out, keep moving up. So today's topic is investments, decisions in consideration of, I'm going to say, high inflationary period. Hey, it's high for the United States right now. I was alive in the 70s. I do remember stagflation, but okay, for most of us who were born in the 70s or 80s, we don't know that period. And so high inflation, pushing 10%. We have interest rates, Federal Reserve rates going to move from 0.25 up to their target 2.8 within 2023. By 2023 or in 2023? Y'all tell me. And finally, we have a world economy that's in flux. We have a Russian invasion of Ukraine that's already disturbing supply chains that by any measure are disrupted. And I'll ask a question later on whether that's a temporal, as the administration suggested last year, or is there really a strategic change going on in corporate thinking about supply chains? Having said that, I'm going to turn it over to our very distinguished speaker, James Nevels. We call him Jim. And thank you kindly for telling us the state of the economy today.
Thank you so very much. It's a pleasure to be here. And whoop, again, this is I had no idea when I joined the faculty, much less as one of your older students, that the enhancement of the value of my degree would be so immediate with with what is going on and today's good news. I want to take the opportunity to say to everyone that when you're as old as I am, and I turned 70 in February, you've seen it all. I was 9 years old during the Cuban Missile Crisis. I've seen this movie before, although being a little older, I understand it. So my hope in the next 18, 19 minutes would be to talk with everyone, and thank you for being here, to talk about inflation through a multiple lens. Having served as the chairman and for a period of time as the CEO for the greatest confectionery company in the world, and we all know which one that is, that would be Hershey, y'all. The linkage and corporate behavior becomes important because those corporations issue debt and they issue equity. And so what are the behavioral things that inflation can bring in terms of that corporate behavior? Well, I have here on my desk a bit of research, and I know that the wealth management, you who are in wealth management, read a lot of the research. And 3 years ago, a report that I have here says that the pandemic and COVID were temporary, and that it would go away by April of 2018. So be it with inflation. It is not temporal. It is here. It is now. I can speak to you from my home, the backdrop, in just outside of Philadelphia. In the second year of the Carter administration, my wife and I bought our first home. It was 16.5% fixed. And the other element was our money market was bearing 22.5%. And inflation, you fill in the blank. So there are those of us who have a slightly longer highway behind us through the rearview mirror. And what we are now seeing is perhaps the natural course of things. The question is, what will be the corporate behavior? Today, my good friend, Patrick Harker, the president of the Philadelphia Fed, a gentleman who I was on the search committee and was chairman at the time, and in a very interesting press release said, the economy is strong, but we are going to do what we need to do by 2023 to get this under control. What does that mean, under control? And how do you avoid slamming too hard on the brakes and taking this car the other way? So today, at this time, I'd like to talk a little bit about potential issues leading through inflation from a corporate standpoint, and yes, even as it relates to the corporate boardroom, and potentially the interaction between corporations, their leadership, who have to interface with regulators of all types, not to mention the interface with government. Preparing a company to battle the sudden rise of inflation is one of the most difficult tasks that a CEO can face and that a board can strategize and help with. I would say, and thanks to my good friend Ram Shram, who is older than I am and is my mentor, there are essential priorities that must be kept in mind. The most important thing is continued cash flow generation and forecast on a very conservative basis. An examination of the longevity of the business and winning against competition is also a consideration. But those are the magic words for the continuity, business continuity. And goodness knows, with the additional element that we're seeing with an outbreak of war in Europe, we become stewards, in effect, of our clients' money, and in some instances of the stakeholders, because we have to be aware, take into account the possibility of intrusions and business disruptions. That's the essence of business continuity, being aware of those potential issues. Having served, and it is public, in the public domain now, having served on a special committee at WestRock after a $50 million incursion, and being on the special committee because of my Texas A&M degree and touching on risk management, you would be absolutely shocked at how important knowing the risk, understanding the risk, and how costly it can be when you tender $50 million in Bitcoin and it disappears in the ether. It's going to get worse, not better. And inflation has something to do with that too. Other things include that focus on CapEx that is very, very important. And in addition, there is the element of the chief executive officer's psychology in good times is focusing on the financials, focusing on profits. I would respectfully suggest that inflation now requires management and the board to move quicker, to utilize the capital in a way that is not dilatory, and to take actions with speed and alacrity, unlike before. You snooze, you lose. That market, that cost of what you're about to acquire is in stark contrast to a low cost of capital. The days of the low cost of capital in relative terms are over. In relative terms. Again, you're talking to an individual who has seen the highest highs. But in relative terms, this becomes an incredibly important element, looking at contracts, making sure what is the cost of capital to acquire. Do you think that we'll have fewer acquisitions in this time period? When money is nearly free, risk gets greater. So I would say, once again, what a difference in this instance 10% makes, which is what Pat Harker said today in a press release in Philadelphia at that element of inflation, 10%. So one of the other things, and I won't spend too much more time because we want to get to the meat of the matter, and we've got some great set of questions. I would dare say that as we sit and look at what we're doing as investment professionals, it requires a higher sense of urgency and diligence. It's real easy to do well when the market is going up. What is the risk appetite of your clients? Do valuations matter? Will this alter the configuration of FANG, of Facebook, Apple, Netflix? Buy them, you win. My beloved instructor, George Mentz, we were talking a little earlier before we came on. Let's dig into ETFs. What are the risks? How much of that S&P 500 ETF consists of the FANG? And how will that impact returns? It's real easy to make money when all boats are rising. Are we ready as investment professionals to do what we really are trained to do, and that is to discriminate in respect of investments? I want you to know how fortuitous it is to be able to speak with you today on this day of days as we watch the School of Law move to the highest tier. Therein is brand. And one thing that I do know about is brands. When I say Hershey, you smile. That's the intangible benefit. When I say Alcoa, you think of Pittsburgh and you think of Pennsylvania. And to have served on both of those boards, the other intangible asset that has to be absolutely emphasized that will bear fruit during an inflationary period is the brand. That will get you in the door. And so as we look at our calculus, we must ascertain and determine the extent to which our investment schema embraces that. And in conclusion, what I will say, because I can't wait for the questions, this is going to be absolutely wonderful. I will say that inflation is not transitory, just like pandemics. They are not transitory. It is a matter of degree. A dramatic increase makes us more aware. And our behavior, as well as corporate behavior and governance behavior and investment behavior, becomes very different, because all of a sudden, I got to do better in inflation. Otherwise, I've eroded my asset. Again, thank everyone for being here. And Professor Byrne, back to you.
Well, we have a lot of questions to get to, pages of them actually. But first, we're going to have commentary from our professor, George Mentz, who again was one of the founders of this program for the wealth management. And he writes these articles weekly on Newsmax, which I've been following recently because I've been confused about what to do myself in an inflationary period. And Jim, you actually brought up CapEx, and I've been thinking about if capital becomes expensive, what should I be looking for in companies? And okay, but having said that, Dr. Mentz, I turn it over to you. What do you think about the markets and where I should be investing that retirement dollar?
Welcome, everybody. This is George Mentz. I thank you so much, Mr. Nevels. And speaking of brands, I'm going to make a little New Orleans joke with Professor Burns here. The Neville family brand is still wonderful in New Orleans, and I'm sure it is in Philadelphia too. So anyway, I used to bump into those guys around New Orleans. They're amazing, and the ladies too. This is one of the most interesting times in the market. I mean, a lot of the stuff we've seen before, like Mr. Neville said, but you know, the types of capital and the types of liquidity and the types of global liquidity are a bit different than they were 30 years ago. The types of debt, national debt, consumer debt, that stuff's different than it was 30 years ago. You can read my articles. I talk about family debt, credit card debt, student loan debt, mortgage debt, everything. The mortgage rates have gone up a point just in the last few weeks. I mean, things are very dynamic. They change very quickly. But I wrote this new article the other day, Mr. Nevels, about how the whole online internet universe is different than it was 20 years ago. These guys are much more nimble now. They have cash. You talked about cash is king. They have cash. They don't have inventory. They're not paying tax on inventory. They're selling it before they even buy it. They used to call it, in MBA school, they called it just-in-time inventory. Mr. Chambers from Cisco referred to it as no-time inventory. Like, we're not buying anything until we sell it. So this whole internet global universe, and you got to remember, Mr. Nevels, too, that I used to sit around and think America was the big cheese. 30 years ago, we're 4% of the global population. There's 96% of the consumers are not in this country. And you have internet companies in America that are doing 99% of their business offshore. They're not even selling to local people. And then you have people offshore that are selling all their stuff to Americans. It goes both ways. And then some of these big companies, like Hershey or one of these large Fortune 500 companies, they may have 50% of their assets offshore, 50% of their inventories offshore, 50% of their 40% of the S&P sales comes from offshore. I'm gonna tell you that right now. 40% of S&P revenue comes from outside of the United States. That's old data. I don't know what it is now, but things are just changing so quickly. And I'm not sure, like Mr. Neville said, that the dynamic and nimble companies will prevail. The top economists in the country right now are talking about how this could be the decade of international stock growth. So it's not just Brazil and Russia and India and China. It's everything else. I mean, you got to figure there's if you forget about Russia and China, just put them aside. And India, you put that aside, you might have Malaysia, the Philippines, Indonesia, the largest Muslim country in the world. You might have countries down in Latin America. There might be, there's 20 something nations that speak Arabic that are part of the Arab League. You've got all these dynamics that people, and then you have Africa with over 50 nations, and you don't know which one's really going to do the taking off. They have lots of resources down there, but you got countries like Nigeria with well over 200 million people just in that country. And there's consumers everywhere. But I've read case studies about one company getting down to Nigeria and selling something, and it turned this company, like I think Nokia or one of these things, became a superstar just because they had one good country, one set of great sales, and they were number one in one big market. So I think we're in an incredibly dynamic universe right now. The inflation, it's gonna kill, it's probably gonna kill a lot of people, and it's probably also you're gonna have a lot of people come out of this thing even stronger and more nimble than they ever were.
Okay, I'm going to start asking my questions then. Okay, George?
All righty.
Okay, I'm going to ask get to the meat and bones. I'm an investment manager. I got a portfolio. I got a target date, 10 years from now. We know our traditional equity bonds or equity debt, but high Fed rate doesn't translate into better value on bonds, generally speaking. In fact, just yesterday, I read that the short-term bond rate had inverted against our treasuries of 30 years. And when that happens, 8 times out of the last 10 times, it equated to recession. So, question for both y'all, equities versus bonds. And when I say bonds, I don't just mean treasuries, but corporate as well. What should my balance be looking at? Maybe not a percentage, in a range, but should I, or is the air going to be out of the bond market, or should I be looking at, by example, the old-fashioned CDSs in, the mortgage-backed securities that were obviously very much disfavor after 08. But maybe if we get back to that world of the Jimmy Carter house buying of Mr. Nevels' first house, that becomes a very interesting market again, from again generating cash and return. What say you two experts? And we'll start with Jim.
Well, in answer to the question, you know what I'm going to say. It depends. What are your objectives? Because George Mentz taught me to understand the client. So assuming that, do you do the traditional 60-40? Maybe. I think that in this time and in this place, again, do I see rates going to 16.5% on mortgages? No. So invest 60-40, be relatively conservative, but be mindful of, as Professor Mentz taught me, making sure that you recalibrate periodically and on a regular basis.
George, what say you?
Oh God, this is a strange time right here. And like Mr. Neville said, cash is king. No matter how you look at it, cash is king right now. Cash flow is king. But if you're an individual investor, you're probably going to be dealing with a brokerage house or a bank or whatever, and they're going to look at you and they're going to analyze your suitability, your time horizon, your risk tolerance, and all that, and they'll put you in some safe, prudent, blue chip type investments based on what you and your family's needs are. So that's kind of the bulk of that. Broker dealers and stockbrokers and investment managers have been somewhat relegated a little bit over the last 20 years as to how aggressive they can be, unless you're young and you're really aggressive and you sign off on it and say, I don't care, I want to do X, Y, Z. So, but I personally, like I mentioned to Mr. Nevels earlier, I like some of the advice some of these guys, the analysis some of these guys are giving now about higher yield, high dividend funds in retirement accounts that you don't have to, it's tax deferred. If it's in a capital account, you're going to have to pay dividend tax on it. That's okay. But what I mean by capital account, just a long account that's not tax deferred. If you have, an IRA, 401k, custodial, all 457, all those types of tax deferred, investment vehicles, or Roth IRA, and you have investments in there, you can circulate them around or keep high dividend yield stuff. And if you have a dividend yield of 5, 6, 7, 8% within an IRA, you're probably gonna outpace the market, and you're going to be looking for funds. I say funds or stocks that have some upside potential. So that's what you're looking for in this environment if you want to beat the environment. But I did do a 1 year, 3 year analysis, and there's a lot of stuff that got way overpriced during COVID. And now it's back down 40, 50%. And so there's some bargains out there. I'm talking in funds, not just individual positions, but if you like Peloton, for instance, it's been beat up really bad. If you like it, might not be a bad investment. I'm just giving you an example.
Okay, so my 2 cents on that one is bonds are going to have a real challenge, because if inflation is running at 10% this time next year, then the returns just aren't there relative to that. I'm going to look for, and that brings me to my next question. I'm going to be looking for equities that can at least beat inflation. Personally, I'm looking for that. And I would like to think of companies that obviously can somehow improve their operating margin, improve their revenue, which means potentially bigger distributions. That's how they're going to beat inflation. That's what I'm thinking, right? What do y'all think? Are there any sectors, industry sectors, that I should be looking at in the publicly listed companies? Is it maybe I should be looking at mid caps? Where should I be looking amongst my potential industrials?
Professor Mentz, you go first. I went first last time.
Okay, thank you, Mr. Nevels. It's my humble opinion that this is the best time to look for good dividend yielding blue chip stocks that have value, that have upside, or good dividend yielding ETFs, and that includes specialized ETFs such as Reits, real estate investment trusts, BDCs, business development companies, CEFs, which would be closed-end funds, and MLPs, which would be master limited partnerships. Now, all these things are, they might have high fees. So you search, you screen them, you look for value, you look for yield, and you also look for the fees that are involved, that are built into these things. And that's where I would be looking. But like I said, that the work from home stocks and a lot of the internet stocks have been beat up recently because of this rise in interest. They think that the interest rates are going to do the same thing to the internet sector that happened in 1990, 2000, 2001. I don't think it's going to be the same this time. I think the brick and mortar guys are going to be the ones that are going to, whoever has the biggest burn rate and isn't nimble enough to go skeleton crew quick enough. So you have all these factors, Wayne, but what sectors I like gold right now. Most people would disagree with me. I like gold. I like silver. I like natural resources. Hell, I like water. For that matter, in some of these places. And then there's a lot of other companies out there. Healthcare has always been a traditional fallback during inflationary periods. Education, that might be different this time because there's a lot of online educators and MOOCs and massive online open courses, a lot of free courseware, open courseware out there that's available now that wasn't there 20 years ago. So education may not keep up. So you have energy, healthcare, and education have been the three areas that have survived well in inflationary periods, and along with natural resources, whether it's coffee or gold or whatever.
Jim?
I would agree on gold and silver. Personally, that's where my wife and I are going right now. You can own it in any number of ways. You don't have to own the physical element. You can, and particularly when you throw in a dash of the Ukrainian invasion, what better place to be than in an ETF that where gold is held, and tremendous hedge against inflation. The other area, but I'm somewhat biased in this, and I admit my bias. The old maxim that people got to eat, and people got to turn on the lights. So if you can utilize an electrical ETF that has companies in it that have flexible public utility commissions that will allow them to capture their costs. That's a possibility. And then, of course, everybody loves to eat candy anyway, all the time. So buy candy.
Okay. So but just to clarify, you're all talking about buying commodities. You're going commodity gold. You're not talking Anglo and Billiton and, and some of our extractive industry. We're going for the commodity itself. Okay, got it.
I mean, even that company from New Orleans, Jim Bob Moffitt's company,
Right.
that's a not a bad place to be. Copper and gold. But I called Mr. Nevels. I called my energy company last month, and I just said, "Is this for real? Did my electric bill go up? No, excuse me. Did my natural gas bill go up 100%?" And they said, "Yes, it did."
I've got it is remarkable. I've bored you, Professor Mentz, about this fly fishing cabin that we have in central Pennsylvania, supplied by a propane gas provider. Same situation, 150% increase. It's a place to be.
So I want to ask about REITs. You mentioned it, George. So one of my questions is, when I was going into 221, so I'm in 2020, and the pandemic's, in full swing, and I'm always looking at the contrarian perspective. And, everyone said REITs are going to suffer. There's going to be no return. You're going to have, people not paying rent. So the residential, the rental REITs are going to be bad. The shopping malls are going to go bankrupt. The strip, you name it, that it's all bad. Don't go REIT. Okay. So therefore I went REIT because as I saw value went down, of course I jumped in, and I was like, and I'm also still a believer that property is property. I don't care if it's in the worst area of town, I still got the land, right? So, okay. Having said that, now we know what happened in 2021 REITs, and I just want to read my little stats here. I was very pleased when I saw this on my own investment accounts. So REITs have had their second best year in history, the entire industry of REITs. How much was residential REITs up? 58% on the year, 58%. Industrials, 62% on the year. However, how can you do that when cap costs so much, when inflation's burning through money and so forth? It can't be the same for 2023. So what is 2022 going to look like if people start to pull out? The question is, what role should REITs play in my portfolio this year and next? Has that money been made? I got lucky that time, I won the lottery, and it's time to move on, or stay in it because there's still some upside I don't see? Who wants to go first? Okay, Jim.
All righty.
REITs, thumb up or thumb down?
That's a thumbs up. Take the money and run.
George, what are your feeling about REITs? And is there a sector of REITs? Should I only do
there's some
residential? Should I go
international
for funeral home REITs?
There's some international ETF REITs that are out there that I still like. If you see value in them and you want to buy them now, there's some cell phone tower REITs out there that may or may not have value. You might want to take a look at that. And then there's some specialized REITs that just own, medical buildings. You might want to take a look at that too.
Absolutely right. Absolutely right.
I was joking
one of the
Jim, but there's actually REITs that focuses on funeral homes, and in the time of the pandemic, that was doing pretty well.
Could well imagine. Again, REITs with a specialization that is the driving force. I went to New York for the first time 2 weeks ago, and was annoyed with my assistant because she didn't have me in the Marriott Marquis at Lex and 47th. Well, what ended up happening was she had me stay at the Lexington. I was annoyed. I walked around to my favorite hotel, the Marriott on Lex, and it shuttered. Premier property. I can well imagine that someone is trying to assemble a REIT, battle the interest rate, because you're just not going to have any more land at 47th and Lex.
Yeah.
It's still premier. So, Professor Mentz, it's always about the analysis.
Well, let's get into supply chain. So the administration last year, the supply chain disruptions are temporary. Inflation is a result of supply chain disruptions. That was the narrative. And the supply chain disruptions are temporary because they're primarily to do with China closing down certain cities. There being too few. I'm just giving you causes that were, explained in these administrative narratives. It was the too few containers. It was the Suez Canal got blocked. It was every month was a different reason the supply chain disruption. Okay. Then we get into December and the narrative started to change a little. It's like, well, I've been saying that for the last 12 months. Now what can I say? Our supply chain disruptions, are they truly temporal? And so, by example, in June, magic, it's all fine. And even including the Ukrainian invasion and the sanctions that are resulting from that, or is this a strategic actual shift to, whether it's for risk management purposes, we're just not going to put all our eggs in one basket, or it's buy USA? What's going on with supply chains, and is it going to impact inflationary pressures going forward? You tell me, and we'll start with George.
Thank you, Dean Burns. I have international relations and contacts in places like Philippines and Indonesia and Saudi Arabia and all these other places. And believe it or not, there were shutdowns more recently than what we had here. So I do believe that if there's not another strain that threatens a large swaths of population in Asia and Arabia and Africa and all that, then I think this might lift. The supply chain issues might lift up a little bit. And on top of all that, all these other industries around the world are scurrying around to try and produce goods and services that people are demanding. But the bad news right now is if you go down to the local automobile dealerships, they don't have anything new on the lots. It's unbelievable because they can't produce those cars. But I think all of that's going to, between Taiwan and Singapore and all these other countries that produce all these chips and all this, or is it Korea or Taiwan? I can't remember who produces all the chips. One of the countries, Taiwan and Korea, I guess.
Korea.
So I say that out loud, but this is a very interesting time. I was saying to Mr. Nevels that, the nimble will survive, but there's got to be people right here in the United States of America who are saying, hey, we can make that stuff, and just so everybody remembers, when the only good thing about the price of energy going through the roof like this is it makes American companies more competitive, because it costs money to ship stuff from wherever over to Texas or Los Angeles or wherever.
Jim, what do you think about supply chains, since you are directly involved in boards of directors who have to think about supply chains?
Supply chain is real. It is a risk. The digitization of the supply chain is a nightmare. And I would dare say that extracting bauxite from the ground in Suriname to do aluminum and alumina is an incredibly risky prospect. So what other alternatives, again, to my earlier remarks, what strategically can be done in the boardroom and with the CEO to make a determination on what are we going to do as an alternative? The good news is Alcoa has gone from when I joined it 5 years ago at a stock price of $8 to a monstrous valuation today of $70, $80. Why is that? We know why.
So I'll just tell you my 2 cents. Supply
Please.
chains are changing. It's okay. So here's the acronym, VUCA. It's talking with Lorraine Eden from our transfer pricing evaluation classes, and her husband actually founded the Bush School of Government at Texas A&M. And so he's always on the world stage talking about supply chains. He's an expert in China and so forth. And I think there's been permanent damage to the supply chain, the way it exists right now, which is, just to say simply, build it, get your raw materials from wherever, but wherever is more and more China, Russia, and unfortunately Ukraine. Get your raw materials, get them to China, build in China. Maybe you reassemble in NAFTA, but in Mexico, and then bring it up the border to United States. And so your containers coming to Long Beach, or they're getting on a train going down to whatever. That's basically our consumable goods supply chain. And I think in the future, the damage has been done, not just because of this invasion and how our geopolitical will be with China, but I think that risk is all of a sudden being, I think, if not, it should have always been understood, but I think now it's being felt the way that we felt risk in 2008, when we had what's been termed the Great Recession, right? So I think that companies, it's a 4 or 5 year strategic move. You can't just, I'm just going to start producing in my, in Mexico. I'm just going to start producing in, mid United States. It takes 4 or 5 years. Capital is very expensive also, as you said, so that's to be factored in. But if nothing else, many more countries will have the opportunity to be part of the supply chain because there'll be a less emphasis on a particular country. But having said that, I think there will be supply chain coming back into the Americas. So having said that, my next question is on just globalization. I've been reading in the economics press, we're a globalized supply chain, global value chain, and so on. And 100 countries go into the components of the 1,200 or 1,500 components of the iPhone, and the raw materials come from these. And okay, we all know that. But if we have entered a new Cold War, and maybe that's a real stretch, but okay, there's some people who are saying that's what's going to happen. And who will even be on whose side? And how does this impact globalization? More relevant, how does it impact my investment decisions? So George, you were talking about international, stock opportunities, international shares, but do I want to be in the Shanghai exchange? Do I want to be in the Hong Kong exchange? Where do I want to be looking if our geopolitical is changing? Is it changing? Am I just off base? Am I just being what do you call it? The sky's falling person?
There's risk and sovereign risk involved with every investment, unfortunately. And we in the United States like like to invest in countries that have some degree of stability. And I think international investments are you're gonna have to be involved in that. Like I said, if you look at the writings of Harry Dent, who's a demographic economist, and he looks at the population sectors of the world and the billions of people around the world, and he said that those businesses have to grow. Those consumers are there. That they demand. There's this 400 million people just in India under the age of 30, and they want stuff. And if you're an American, you better be willing to invest in somebody selling stuff and to the people of India, because and that's just one country. We're not even talking about China or Arabia, or South Asia or Africa or Latin America. So we got all this. You have to think outside the box. It's not about microeconomics so much anymore. It's macro, really, in my mind. I like international investments. Unfortunately, I was one of the guys that really was on the front end of China, and I picked a bunch of Chinese stocks, and I was there in 2003 and 2004, and I had friends of mine that made millions, and I just didn't. I wasn't in the 10 cent and the Baidu and all the stuff that just flew, did 10x, 20x, all of that. But what I'm saying is that there's more. If China did that, then it's going to happen in South Asia and Africa. It's in Arabia at some point. It's the same type of activity, and just from a technological standpoint, Mr. Nevels and everybody here, is 20 years ago I couldn't just open an account with interactive brokers and say, do you want to be on the India exchange and the Hong Kong exchange? You can just go on there. You can say, I opt to be on to trade stocks on the Shanghai exchange or the Hong Kong exchange, and you're in, and you can invest and buy symbols, that are just numbers and stuff like that represent some stock somewhere. And but you could, the research is out there. Everything's more transparent than it's ever been, I guess. The U.S. stocks are smart though, and the ETF growth in the United States has been so wonderful in the last 10 years. You can buy ETFs that represent stocks and holdings in all these different countries, all these different sectors, and you don't have to do all the guesswork. These guys will do the work for you.
What do you think, Jim, about globalization? Since again, you're on boards, and you're thinking about globalization and consumers and supply chain.
70% of WestRock's business is international. It's global. The 30% of which, and this is all public information, of the remaining 30%, 10% is with Amazon. Turn your Amazon box over, and it will be either International Paper or WestRock. So that's the case. Number two, there is, and when I talk about inflation again, there is an opportunity where you are seeing the shifting of manufacturing outside the United States in an effort to avoid inflationary trends. So or inflationary impact. That is most definitely the case with paper and packaging, and also aluminum. In addition, if you're a fast-moving consumer products goods enterprise, my dream, which was not actualized, I wanted to make sure that in the People's Republic of China, that every human being would eat a kiss a day. You can't give up that market. And to Professor Mentz's point, the people are there, the markets are there. You can't, as a fiduciary and as a corporate fiduciary, can't forsake it.
So I have a question about the M2 money supply. I know that's the point of y'all before. just my little thing, because I don't hear it talked about anymore. But so here's my stat that I was focusing on last year, and it seems it didn't pan out. I just don't understand this. Maybe y'all can explain it to me. So last year, in February, the M2 growth was the largest ever, over 27%. And to me, the way I learned economics when I was in school 28 years ago, or whatever it was, 30 years ago, sitting in my economics 101 class, more money, in the hands of the same amount of people chasing the same amount of goods equals inflation, right? So when I look at the M2, because that's what I'm thinking about. Now, that's obviously doesn't, it really, well, it impacts, maybe influences, but it doesn't take into account institutional money and so forth. Okay, so is money supply relevant anymore? Or are we just past that as a our economy is a services-based economy, and most modern economies are, and they're based on intellectual property and tangibles like brands. You brought up, Jim. Well, what should I be looking at to tell me where inflation is going?
I would suggest there are so many instruments out there, and I'm just not sure that M2. And remember now, I'm the old guy here. The velocity M2, M3, all of that was de rigueur 30 years ago, 40 years ago. I think that it's an indicia, though, that you have to look at, because it's not coincidental that M2 spiked the way it did, and then you have this raging 10% that my friend Pat Harker talks about that is unacceptable in terms of inflation. There is something driving this. Somebody is purchasing something, and because of its desirability, its price is going up, which is why, again, to my original remarks, when your cost of capital is low, you don't care as much. But again, you snooze, you lose. It's going to cost you more, and it's going to impact your capital expenditure. It's going to impact your bond covenants, your coverage, all of that. And the one thing that isn't going to go away is the rapidity of information and its dissemination in the financial community, namely the analysts. Although personal bias, I think they're kind of lazy, but people listen to them.
George, what say you about my still looking at him too? Am I just in the past?
I think that the amount of money that the individual family has in credit card debt has moved a certain way. The amount of money that people have in student debt has moved a certain way, and also with the commercial or business debt has expanded in a certain way over the last 30 years. And then you have all these people that have these cash accounts, whether they're cryptocurrency or PayPal or Venmo or whatever. I don't know about you, but I know a lot of people that have thousands of dollars sitting in their PayPal account. I talked to my IRS friend and who used to be in charge of crypto, who's been a guest speaker with Texas A&M, Dr. Udsky. He just retired from the IRS, but he said all that stuff really, that's not a form of fiat currency, and it's not monitored exactly. So those are all technological changes that haven't really been assessed or dealt with yet, I guess, by the government powers, which I'm assuming will be changing over the next few years. The way you have to file your taxes.
Since you brought up digital currencies, should I be looking at technology companies that invest in blockchain? Should I be looking at digital currencies themselves as potential investments against inflation? Do they have a role to play in the line of the same vein as pun there, same vein as gold? Or are they just their own thing?
I think this is a great time, William, for everybody here to take a look at the cryptocurrency and fintech infrastructure as a whole. You don't have to buy the actual coins, but if you owned a fund that owned, say, 10 or 20 stocks that represented the picks and shovels of this industry, it'd probably be a safer, I don't know if anything's safe, but it would probably be a reasonable assumption that you might be able to have a long-term expectation of solid growth in that area.
I would agree. I've been traveling as part of this BCIU organization, been to Abu Dhabi, Qatar, UAE, and met with Mubadala's chief investment officer, and he said everybody ought to be in blockchain, at least 5%, and that really struck me as very powerful. He said, as long as you can afford a minimal investment at 5%, and he talked about the ETFs and so on and so forth. And I don't know what Mubadala does in terms of blockchain, but it's kind of like making sure you have a cup of milk every day for the calcium.
So one of the audience questions is about LNG, but I'll ask it more generally about energy. And but I mean, Germany, 40% LNG. Their minister recently said, oh, they're getting it down to 20%. But okay, I kind of roll my eyes because of this. Germany has no LNG facilities on the ocean. They don't have a way to bring it in. And so it has to come in by pipe. And regardless, the United States somehow is going to get it there. And wherever it comes in, maybe Rotterdam or something like that, I don't know, gets to Germany. Well, if we're sending all of our LNG, that the point is that energy prices are going up. They're already high. We already know that they're one of the leading contributors right now to our current CPI, having moved up. That's not going away. The recent poll by the Energy Department of all the energy companies leaders, most of them respond. You have 200, 300 respondents each month, and they're looking at the absolute minimum is above $90 a barrel for oil. Some of them are, 15, 20% of them are at the $120 a barrel, and then, everywhere in between. What say you for energy and LNG and, is somehow magically solar going to, fill us in the next year or two? What's our prognosis on, should I be investing in energy? Is that the place to put my money? How is it going to drive inflation?
William, I simply don't know the answer to that question right now. It's just really speculative. So I'm going to defer to Mr. Nevels.
Well, Jim, what do you think about energy? You think you think the prices are going to stay above 90 a barrel? I know that one's hard to answer. That's an industry question. But what you can say is, if prices stay above 90 a barrel, is it possible to bring inflation down below 10%?
Oh, that's a great question. That's a great question. I come out of the era where there was almost what appeared to be 30 years ago, an inextricable link between the cost of the pump and the direct impact on goods, services being delivered, et cetera, et cetera. I'm just not sure whether that exists anymore. I'm just not sure.
Yeah, I agree with that. The psychology of the market, sometimes I just don't understand it in terms of where the actual price is. And of course, the price, if we adjust it for dollar terms, maybe back to the 80s. Defense industry. 1 year ago, I told everyone, you've probably already taken all your money out of the defense industry. You're not investing in defense stocks right now, but if you haven't, certainly it's the time, right? Oh, how I have changed my tune. So just last week, I was like, what? You're not heavily invested in companies that make missiles, that Lockheed, Jet, and so on. Okay. What say y'all about defense? So I can buy like George is talking about ETFs, I can buy one that focuses on defense. What say y'all about that? And again, is this just a passing phase and we're going to go back to last year when it was like, okay, we're not investing in defense. In fact, if we look at yesterday's budget, or now 2 days ago's budget, wasn't yesterday's, defense spending was, what say y'all?
Certainly in the short run, the question boils down to the particularly defense spending in the defense of NATO and the US deploying its military capital, but not its human capital, to maintain the venerable treaty. Long run, that's not a bad idea. Now, what does it do to inflation though? You've got a federal government that is spending a lot of money, more than it has. And one of the things that inflation is the silent killer. How? Because with inflation, what happens to the national debt? And who's going to pay it? You got it. George, you got it. I mean, we're mortgaging the future of our children. But so there's my answer. But yes, invest the defense with these massive numbers that are being spent certainly makes some sense. But from an inflationary standpoint, it's not a good place to be.
I agree. I think psychologically, the only thing that I could say is the people in this country probably don't have an appetite for another conflict, really. So they'd probably be willing to invest in any kind of robot or missile or whatever, as long as they don't have to send their child somewhere to fight. So that's kind of where the mentality is.
So Lockheed, good investment. Build things that blow up. Lockheed's a big employer here in
Right.
Dallas-Fort Worth.
Right, you bet.
They're also part of they've announced that they would help us build a new campus. So,
oh, good.
And they do build stuff. They build stuff that gets used. So okay, I'll round out my questions and give y'all a final say. But again, 2022, forgetting 2023, only what remains of this year, 3 quarters. I got $1,000. Where do I put my 1,000? Where do I put my $1,000? Bitcoin, you tell me how you would allocate my $1,000 if that's all I got, and all I got to think about is 2022. I don't have to think about the future. We'll start with you, George. You got the articles.
I think that BITS or GIGE, the gig economy funds or the Bitcoin infrastructure funds look good. I'm going to make a joke to your A&M audience. They might legalize marijuana next week. So I don't know what that means for your investment play, but talk to your stockbroker about that. Golly, Mr. Nevels was in the candy business. There's areas of in the beverage industry that are interesting too. But I like international stocks, and I think if you put $1,000 in some type of international type position fund, you'll do okay over the next 10 years. That's all I can guess. If it's a nice diverse asset allocated fund in different sectors. Anyway, that's my 2 bits.
Okay. Put my
Thanks again, everybody.
in international from George's perspective. What about you, Jim? Where am I putting my $1,000? I'll split it 500 each. Where'd I put it?
Fast moving consumer products goods over long term. If you eat it, buy it, and then I'd look at George. I think you're right. I think you look at the gig economy. I don't understand Bitcoin. I haven't delved into it to understand it. I would get an ETF, buy it, and as they used to say many, many years ago, I'd set it and forget it.
Okay, so, and I'll just tell you, I'm as I've already mentioned, I'm big on locking up, but I'm big on defense that make technology that are going to be used in the current thing for this year and next. I think the budget's going to support that expenditure, and we're going to see that return. Whereas a year and the stocks got a little bit of pounding last year, so it's a good time to have been in there. I agree with the consumables and Nabisco's and the food companies that the brands of foods that are going to be consumed, because in times of historically in times of recession, people still eat and they eat candy. Those, you don't do away with your candy expenditure. I think that the big energy is safe bets, your Exxons and so forth. I mean, you still have to look obviously at operating margin. It doesn't matter what the gallon, the barrel price is, if their operating margin is going down, but it's not. They're becoming more lean, efficient. The price to pull oil out of the basin here in Texas, $75 before the in the mid 2000s even actually was up there. And now, not to drill a new well, but to pull out of an operating, I've heard of prices at 35, but whatever, 38, 40. You can drill a new well in the Permian Basin right now, $50 break even point. So, I mean, I'm confident of, in particular, Texas-based oil companies for my $1,000 investment this year. And so we'll come back and redo this. We'll see if I made some good bets. And y'all on the international, George. I'm a little less on the international. I think that sanctions are just are kicking off, and that they're going to reverberate. And we might have I think the supply chain disruptions because of sanctions and so forth are going to be felt a lot harder and impact inflation, I think, more than y'all think. And because of the rare earth minerals being in China, Russia, and so forth. So unless we have some, discovery of rare earth minerals, North Canada, or Colorado, where you live, George, rare earth minerals have just been discovered in Colorado. Unless we have that, it's we're going to be in some inflationary pains as a result of just not being able to make product, as we saw the last year with cell phones and so forth, or not being able to deliver cars, as y'all mentioned. So with that, if each of y'all, I'll start with you, George, then we move to you, Jim, for the last 1 minute, 2 minute, warning, if you will, risks to be looking for the coming year on our investments. What are those?
It's Mr. Nevels. When I saw that the mortgage rates have gone up in a point in the last few weeks, and then I see that the oil and gas prices and the heating bills, I think that the biggest risk we have right now is the Main Street discretionary income may be whittled down a bit, and I don't know who that's going to hit the hardest. In 2009, Mr. Nevels, I noticed an interesting trend. A lot of stocks did really well in '09 that provided lower cost products and services compared to the more luxurious type meals or equipment or clothing or whatever. So the Walmarts and the Chipotles and the Wendy's and everybody did good in a really horrible economy. But I assume that will happen this year as well.
I would totally agree. 37% of Hershey's, and again, this is in their SDNA in the proxy. 37% Walmart. 37%. Say no more. And I think that additionally, to your point, Professor Mentz, the inflation will do the most damage to those least well off, without not having the discretionary income. And so the real question then becomes, what will be the result? What's the chain reaction? It's not good. It's not good. People that are hungry, people that are dislocated, and then there's ultimately the question, will there be a safety net, and will the net be there in time? So the consequences just spiral out in terms of I mean, one of the things that just surprised the hell out of me, because I started as a municipal bond lawyer before going to work at Smith Barney, as I've told you, Professor Mentz. And up until this point, municipalities, states in their municipal bonds and municipal bond obligations, they've been absolutely flush with cover. Their coverage ratios have been through the roof. We'll see what happens now.
Well, we've reached the end of our webinar, but one of our students, or she's graduating, but she did ask a question, so I do happen to like it, so I will throw it out there, which was about agriculture, the ADMs of the world. We all know that, how much potash comes out of Ukraine and Russia, how much fertilizer, those prices through the roof, right? So in fact, with sanctions, the answer should be none are being, or at least imported into our country. And so if you're, small farmer to an ADM, your costs are through the roof, i.e. commodities are through the roof, So I'll tell you my 2 cents, and then we'll end with y'all telling your 2 cents, and we'll end the webinar. My 2 cents are, this is going to be a real bad Christmas year, i.e. 2022. We spent our money in 2021. It was a great, when I say Christmas, but it's always that fourth quarter reporting for retail, right? Our fourth quarter 2021, out the roof, right? Credit card debt went up. People went and spent money that, whether they had it or perceived that they were getting it or whatever, it got spent. And now Fed rate goes up, credit card interest goes up. People feel the pain. Commodities prices at the Kroger's, at the whatever store you have near you, the Albertsons, go up. Again, people are feeling the pain. My gas bill goes up, like you were talking about, from the heating, my petrol bill to fill my tank. We're going to come into October, November buying season for retail, whether it's, textiles or TV sets. And it's just not going to happen this year. That's my prognosis. And therefore, I don't want to be in those investments. Again, I want to be in Lockheed, whatever. I want to be in defense contractors and stuff like that. But from an agricultural point of view, are there any agriculture investments out there right now that are their operating margins are being cut? So is that a smart buy, or do people need food so much that prices are just going to go up to meet the inflation rates, and they're going to do just fine. What say y'all? And then we'll end the webinar. Who wants to go first?
You're talking to the wrong guy, because I'm a chocolate guy. People got to eat. People got to eat.
They do got to eat.
I mean,
I
they
wanna
got
show
to
you
eat.
sugar.
I mean, they got to eat. And if they don't, are unable to afford it, what's going to happen? That's going to shift to other sources for payment, i.e. transfer payments. The Secretary of Agriculture will become the largest food buyer in the country. So people got to eat. I'm there.
George, I'll give you the last word, and then we'll end up our webinar today.
I just want to thank everyone for being here. Thank you, Professor Burns and Mr. Nevels. I'm going to start calling you Professor Nevels. Now that you know, but I'm so glad, so honored to be with you today. And this market's crazy, and the inflation. I don't know where it's going to stop right now. If you look at coffee prices or anything else, I go to the grocery store, and all the stuff I like is 25% more than what it was 6 months ago. Everybody here knows that the cost of energy dramatically affects the basket of goods and the consumer price index. Everybody knows that. What do you do about it? Honestly, the consumer, do they call it just consumer durables, Mr. Nevels? Is that what everything you got, everything you gotta have. And if you're an investor, I wrote an article years ago, and the truth in that article still holds true today. You look at where you're spending your money every month. That's where you need to be invested. Ask your neighbors where they have to spend the bulk of their budget. That's where you need to put your money, because those companies are going to do great. Anyway, thanks everyone, and God bless.
I really thank y'all for coming and for presenting with us today. I hope we can do this each quarter, at least half-year updates, and kind of track ourselves, just like I take pictures in the grocery store, because it's like milk used to be $2. No, I actually have pictures. I know what milk was, and I've been doing it for years. I love cell phones, right? And this is my acronym. I realized I said an acronym, and then a lot of listeners might not know what that acronym is, VUCA. So it stands for volatile, uncertain, complex, and ambiguous, VUCA, VUCA. It's a new terminology, been used in the last, 2 years in our classes by Rick Kravitz and Lorraine Eden and so forth. So we live in a VUCA world: volatile, uncertain, complex, and ambiguous. And if we have $1,000 and we invested it, like we said today, we'll come back at least by the third quarter and see if we made money or lost. Okay, cheers, y'all. Thank you very kindly. And again, whoop for Texas A&M becoming first year. Cheers.
Absolutely. Take good care.